Well, equity markets are grinding lower, and the combination of higher bond yields and a weaker China and a US dollar, which is finding a lot of love in this market, is causing anxieties building in markets. We're seeing gold trading south of $1,900, and we look ahead at Jackson Hole, another key event risk that you need to have on your radar. This is the trade-off. Well, hi there, my name's Chris Weston. I'm going to be joined in 2 seconds by Blake Morrow from Forex Analytics, and we're going to be discussing all the factors that are going through the world of markets. We are seeing a slight change in sentiment. Whether that sentiment continues to last is obviously yet to be seen. That's something I'm very, very keen to explore with Mr. Blake Morrow. So, Mr. Morrow, come back into the programme, good sir. How you go?
Hey, Chris.
How you go? You well? Are you in? Did you get any of the England versus Australia, the Lionesses versus the Matildas game last night at all?
I did actually. Ironically, when I got up this morning, I had realized that the game was ongoing, and so I caught the last third of the game. It was what a great match, and
what a goal! What a goal from Sam Kerr! What a goal!
It was amazing. It was an amazing match, and I was telling people that I was talking to about this whole situation. It's like you can tell all these teams are rightfully hungry. The U.S. Exceptionalism. We can talk about that in a little bit. But, for the U.S. women's national team, it looks like they're off the table for, I would say, for quite a while. I think they've got a lot of rebuilding to do. Therefore, it opens up the door for some great teams to come, rise to the top. And I think we're seeing that. And it's fun to watch.
Well, we've got Jones coming back for the final after her incident against Nigeria. I think the English defence was rock solid. And I think that will give us the platform. But I'm calling England 2-0 for the final. What's the Morrow bet?
I'm going to go into a PK shootout, 1-1 PK shootout, and you notice I said penalty kick shootout, Chris. That's what we call it here.
The
on
Americans just make
the
up their own language, don't they? It won't catch on. I can guarantee that. Anyway, let's go into topical thunder. I'm calling the Lionesses, and yeah, let's see. Hopefully the ladies get it done. Anyway, let's go into topical thunder. All right, I'm going to bring up volatility because, we are seeing a bit of drawdown coming through in equity markets as we go into options expiry. I think a lot of the dealers have been, short gamma, and they've had to hedge that position, hedge the delta as the market moves lower. They've been shorting S&P futures, individual stocks, and I think that's kind of moved the market a little bit lower. Sort of technicals have broken down through the 50-day moving average in the S&P, which has been a really good trend filter for some time. And the US dollar's rallied as well. So I think this combination of high yields, which we can get on in a second, and the stronger US dollar, and obviously concerns around China's property space, the credit markets there, and also just the general economic malaise we're seeing, the lack of fiscal, I think is causing this. But I think the one thing that's really been missing in this whole cycle, Blake, is volatility. And if we're seeing high volatility, then volatility breeds high volatility, as a lot of these volatility targeting funds have to, take money out of the equity market. We haven't seen that. The VIX is still trading around 16%. FX volatility is still pretty low. You can look at the MOVE index, which looks at, Treasury implied volatility, and that's hasn't really moved too much through this situation, despite yields moving up. It's been a grind rather than this big impulsive move, and I think that's the missing piece of the jigsaw is volatility still pretty subdued. Once we get past OPEX on the weekend into next week, does that mean that we're going to see a high volatility regime, or do you still think people are not acting on this at the moment?
Well, that's a good question, and I want to make sure that you all stick around for the end of this show, because I have a volatility play that I'll be putting in there, just squeezing in there. But I do want to say I think the word of the day is orderly. The move that we've seen down in equities has been somewhat orderly. A lot of people have been attributing it to the OTE options that are
0 days to expiry. Yeah,
ZTE, that's whatever it is.
Yeah.
Sorry, it's at the end of the day for me, so I'm 0 time to expiry myself personally. So
very good.
So I think we've just seen an orderly decline, and it is summer. So, but as you pointed out, volatility might just feed on itself. I look at the current situation as more as like a domino effect, and right now we're seeing certain commodities are holding up. They're right on the verge. That was one of my borderline topics today was talk about commodities, but I think you're starting to see the dollar really, get to a point where it's a make it or break it. Equity markets still can pull back a little bit and not disrupt the overall trend, but we're getting to some big inflection points. And I think if you start to see some of the commodities break, you see the dollar break, you might actually see volatility increase. And so, like I said, it's a domino effect. I think as a market participant, you're starting to see the signs. And you're like, okay, if this happens, this might happen, and they're all starting to fall. You're starting to see those dominoes knock over. And the last one is usually volatility.
I think you make a good point on zero DTE, though. I mean, that's last week that made 55% of all options that were traded were zero DTE. So it's a massive effect now. So less people are trading strikes that feed into the VIX, for example, those longer, the ones that average weight into a 30-day. So so much of that options activity is taking place zero DTE. That people are less inclined to sort of buy those longer dated downside puts effectively, and people are buying dollars to protect their portfolios. I think is a big one there. So. And I think if you'd see higher equity volatility, it always starts from in the rates markets and bonds markets. And if you see rates volatility increase, that has big implications for using treasuries as collateral for repo purposes. And that's where FX and equity vols really spike up. So I'm watching the MOVE index very, very closely indeed. If that moves up higher, no doubt you're going to see the VIX above 20%. It's not there yet.
There you go. Watch the MOVE index. And speaking of which, that's a good segue to talk about this move that we're seeing in the bond market, Chris. And I know I've posed this question to you before, but really when you're starting to see the equity markets roll over, you're starting to see the dollar really firm up. The dollar is getting to some pretty key technical levels that we'll talk about here momentarily. Way back when, or let's just think maybe a couple of years ago, there wasn't a lot of places to hide out there. You had the dollar, you're like, okay, I'm going to start buying the dollar. Maybe I'll buy the yen. But right now you have actually, the bond market where you can actually start looking at, some of these, higher yielding, it doesn't matter what end of the curve you're at, whether you want shorter term or longer end, maturities, bonds could be posing a little bit of an attractive yield at this point, but bonds continue to sell off. And we continue to see yields drive higher. And this is one of those dominoes that's kind of following that the dollar is also following alongside. But I wanted to ask you this, based on your experience and what you're seeing, what's driving this move in the bond market overall? Is it inflation expectations? Is it rate expectations? What are you seeing out there with your clients that you're talking to?
Well, you can get really technical on this sort of stuff and start talking about term premiums and the compensation you have for rolling down the curve. But that's a factor. So go and Google that one because term premiums becoming less negative. I think it's the supply issue, to be honest, is the main issue. We've seen that last couple of weeks. The Treasury have issued more bonds in their refunding announcements than what have people previously suggested. And you go into the next quarters and we're going to see more supply coming in. So it's a supply issue. So that's what's lifting 10 and 30-year Treasury yields in that guise. So, would I be buying? I wouldn't personally. I think there's, it's going up at the moment. And I think, for a lot of leveraged funds, unless you're like a real money pension fund, but if you're using leverage in the bond market, which a lot of hedge funds do, the cost for overnight funding for collateral to get that leverage is really expensive. So unless you're buying with real conviction and you start thinking to yourself there's a real strong chance of a recession, you just wouldn't be buying bonds with any kind of leverage in the fixed income market. And that takes a major player out of the market because the cost for that overnight funding is so expensive. So one of the big buyers is out the market. You've also got the Fed and other central banks are out the market. These were a price insensitive central bank who have removed the mouse as well. So to buy bonds, you have to have huge conviction that we're seeing a longer term disinflationary spiral and that we're going to see a recession risk. And that's why you've taken a lot of the buys out of the market and it's been quite easy to move yields higher. And that's where we are. So I wouldn't be buying at this level until the market gets strong conviction of recession, which is not the case at the moment. I think people will continue to push them higher and that's lifting the dollar. So I think it's supply, the removal of a massive buyer and also leverage buyers out of the market. And the fact that the US data continues to come in stronger, I still think there's further upside The one you want to look at, though, Blake, of course, you've probably been speaking to your clients about this, is real rates. This is the real cost of capital. And 10-year real rates at the moment are just sitting shy of 2%. I think that's one of the big issues that's impacting markets at the moment. So higher bond yields, for people out there who didn't go to university and study finance, applied finance, go up and have a look at the idea of the net present value of investments. And there's a hurdle rate or a discount rate that you use to work out the net present value of an investment, and you adjust the expected cash flows of investment, and that is the 10-year treasury or the 10-year real rate. And as yields are going higher, these future cash flows are worth less. The net present value of these investments are falling, and I think that's part of the reason why high yields are reducing equity valuations there.
I love Weston University. Love it. Absolutely love it.
So it's probably a lot to some people, but ultimately that. Yeah. If you're interested in that concept, that theoretical concept, which seems to be making down the hurdle rate, and that's all for business owners out there as well. For people out there who run a big business, you're looking at this idea that I can go out and I can expand and borrow money for expansion purposes. There's a choice you make as a business owner, and that is I could go to the risk. I could go and borrow 10-year. I could go and get a 10-year treasury at 4.25. Risk-free, effectively, you're going to get your money back. Or I can take this money from the bank, which is the cost of capital, and I can use this for expansion purposes. But am I going to get a return relative to the risk-free rate, for those right. Expected cash flows I'm going to get? And right now, you're probably saying to yourself, no. And I'm not going to take that project on. I'm not going to expand, because the cost of capital to get past the hurdle rate to make an internal rate of return is becoming higher and higher and higher. So that's when the cost of capital in the treasury market's moving up. You're saying to yourself as a business owner, I'm not going to take that expansion plans on right now, because the cost of capital means for me to break even on that investment, those future cash flows from that project, is just becoming higher and higher and higher. So you refrain from taking that on. Of course, that lowers demand. So that's another really important point. Anyway, I want to go into the US dollar, Blake, because apart from the pound, which is also motoring along as well, the US dollar's making all the right plays. It's got this kind of safe haven quality that we like about this. If you are looking to hedge your downside in the equity market, as a sort of cross asset manager, you've refrained from going in gold. But you can go and get 5.5% for a 6-month T-bill. Why would you want to go and play in gold in this market? But the US dollar is negatively correlated to risk for equities. So you've got probably the best hedge is the US dollar in the market at the moment. You can go and buy a put and get that downside as well. But I think people have been using the dollar as a hedge. You've got that cyclical factor as well, that exceptionalism story. Have a look at the nowcast model that the Atlanta Fed are at. I know it's a ridiculous number. It's like 5.6% or something. But it's never going to realize at that number. But it just shows you, the data has been coming in strong. China's a clear concern. We can go to China till the cows come home. But, the US dollar right now is looking so good on a number of factors that I've coined this magical currency, and it's moving up in the right direction. So CTAs and trend following funds have been piling in as well. I still like it. And dollar CNH is right at the heart of everything I'm seeing, and that's just going up, as is dollar yen. So I still like the dollar on dips. How are you playing it right now?
I'm playing it on the long side. I actually have $1 short, but $3 longs that I'm playing currently. That would be my book, if you want me to talk my dollar book, that I've been playing literally for the last couple of weeks. And if you're like, I look around, I look at Europe, and I just heard Christine Lagarde. She's sound really dovish for departure from way she's been recently. So Europe, don't want to be there. UK, maybe, but how about if they want to fight deflationary pressures by lowering rates again? Maybe I don't want to be long the sterling. China, that's your Antipodean issues with whether it's the Aussie dollar, the Kiwi dollar. Canada looks like an absolute disaster right now. Maybe following the fires. Plus, you got a rollover in crude. I don't know if I want to be long Canadian dollars, so I'll buy the US dollar. Then you got, as you pointed out, the US dollar CNH, which looks exceptionally strong. That's one of those levers that the PBOC could pull a little bit and weaken the renminbi.
Using the FX reserves.
Use it, and make exports a little bit more attractive, for the rest of the world to China. And then you got the Bank of Japan. that's really the only one where the BOJ at some point could say, I'm checking rates, and or the Ministry of Finance maybe check rates, maybe you get, because we're at intervention levels, right, Chris? Right here around the dollar yen. Last time
I've got a chart.
We saw intervention.
Yeah,
but we're real close, 145, 146. If that happens, I don't necessarily think it's a dollar story. I think it's a yen story. So that doesn't really disrupt anything either. So bottom line, I'm more weighted long dollars right now, and I'm going to continue to do so. While there's risks, I see risks in the market. And
it's kind of, if there's, you brought up a really good point earlier, and that is the exceptionalism story. It is the exceptional currency out there at the moment on so many fronts. And that's just making it appealing. You've got to ask yourself, what's going to change that? Is it the Bank of Japan? I think China has to do something more. There's all these property concerns. There's so many of these property stocks, property companies which have issued debt, and they're trading at distress levels, less than 10 cents on the dollar. Obviously, Country Garden and other names as well. China have stopped publishing their youth unemployment numbers. I mean, this is just, it's tactically, semantically, it just feeds through to a lack of transparency, which most people in DM markets already know that there's a lack of transparency. The fact they've stopped publishing youth unemployment numbers because they're at 21% and they may cause social unrest, I think is just what we're seeing. So you've got property concerns, you've got lack of trust, and you've also got an economy which is stagnating, and the market is crying out from the Chinese government. You promised us fiscal after the Politburo. We're yet to see it. Give us more. You need it. The PBOC is stepping in. So I think China, we haven't talked about it here, but it's just incentivizing people to be long dollars in that environment.
Yeah, it sure is. And so dollar, I think it should be on everybody's radar. If you're not long, buying dips, that's kind of the mode I'm going to be in, especially with equity markets where they're currently at. Now, that turns us to our next topic, which is going to be inflation. And, today I was mapping out for the traders that we in our community, the FOMC meeting minutes. I'm like, the worst possible case scenario for equities is that the Fed is going to say that they can, the Fed governors will say they could see further tightening. And really that's what happened. There could be further tightening. The market has to say, okay, maybe the 2024 rate cuts aren't going to happen. So then we got to reprice. Stocks will come down as a result. And that's kind of what happened by the end of the day. So, the headline that I saw is inflation could require further tightening. And Fed funds, Fed minutes set to show only a minority saw the end of tightening. So a minority. I think if you look at the Fed governors, it was like 4 out of the 7, or 4 against 7 or 8, something like that. And also to top it off, we're at the 1 year since we had the Inflation Reduction Act, which is silly to say, but it is. That made news, believe it or not. But on the flip side, Chris, you have commodities. They look vulnerable. You got crude oil that looks like it's going to come down. One of the big inputs into inflation is energy costs. Housing still looks obviously pretty strong. And that's going to be a big factor too for inflation. But then, so you got a lot of cross currents here. And you look at the UK inflation data that came out overnight. It came out pretty strong. So I'm wondering, in your view and how you talk to your clients and your customers, do you see the inflation fight being over, or maybe these disinflationary pressures are going to continue to accelerate?
Mate, it always reminds me of the saying, it's not about being right; it's about making money. That's what we do, right? True. So, I think the Fed are data dependent. I mean, that's what I took out of it, and I didn't really read too much from the minutes, to be honest. They're thoroughly data dependent. We need to see the payrolls number coming out on the 1st of September. The average daily earnings will be interesting. Yeah, they've been going up, but that's largely a function of people working less, and that's pushed the average up there. The next CPI print comes out on the 13th of September, and all signs are that that's actually going to increase. So we're at 3.2%. Sorry, we're going to go up to 3.6% on headline, and I think that's largely a result of base effects from higher crude prices in that market. The market is pricing 3.6%, and then the September numbers, when they come out, will be another higher read. So I think we're going to start seeing inflation moving up a little bit before it then dissipates over the next 12 months again. So we've got a couple more readings of higher reads there as well. And that may mean that they may have to raise rates in November. I don't think they're definitely not going to raise rates in September, in my opinion. They'll skip that one. And that CPI number on the 13th of September, could mean that they may raise rates in November. They're not going to raise. There is no meeting in October, so I think that November one could be where we get a final one. But they're data dependent. If that CPI number comes in hot, if we get a really strong payrolls number, some of the other data continues to trickle in this way, that they'll raise rates, and that's again another supportive leader for the US dollar. Sorry, go on.
And I was going to say, so that makes, based on the minutes that we got today and the way that we all interpreted them, that's probably going to make Jackson Hole, the symposium, as you pointed out, probably one of the key events over the next couple of weeks before
100%.
we get everybody
Jackson Hole 24th. So we're looking. I mean, I'm not sure if actually they've come out with the explicit list of speakers and the timetables. But if JPAUD comes up, the thing everyone's talking about is this concept of R star. What's the real neutral rate of where the interest rate should be in the US? And there's a belief that he could lift that and suggest it's higher, which means that that where the interest rate needs to be for a longer period of time needs to be higher, and that's bullish and hawkish. Hawkish rather than bullish. So that Jackson Hole is going to be critical. We're waiting for confirmation around that situation there as well. So, a big one.
Change the rules. Why not? If things aren't working, let's just change the rules.
Exactly.
Let's do it.
Yeah, why not? But this is not for us. This is for your MITs and your Harvard MIT PhDs to come out with something that's non-observable. It's a number which people just create models and no one actually fully agrees. So something to be. Jackson Hole's the big one there as well, but. We just don't know what's going to happen with inflation there. So we do expect to pick up in the short term. But that dollar continues to be a nice currency to hedge against that risk. Anyway, let's move on to that's a setup. Right, so we've got two charts, one of mine, one Blake, and then we go into two viewer ones. For you guys out there, if you've got a setup that you want to talk about, or you want Blake and myself to go through it and give our views, we want to hear that because we want to pick out one of the best ones each week. So you can see Sterling Aussie CAD viewer questions there. Do put them in the comments channel, and or you reach out to us individually on Twitter or wherever you want to go. But comments is probably best, and leave your charts and what you want to talk about there, and we'll bring that up next week as well. Anyway, let's start off with dollar yen. So I know this is a hot conversation. This is a hot conversation. I think they call that in France topic du jour. But you can see the breakout there. Now, tactically, this is a tough one because, it's going up. I want to be long. You can see those series of green candles. It just goes up, 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 makes higher highs. Every pullback's defined in that 5-day exponential moving average, which is really what you want to see in a really strong, impulsive move, where there's really not many sellers of this cross or this currency, and it's just moving up. But, you mentioned this intervention levels, Blake. And where is it that people start getting hot under the collar? We're already seeing a few noises from keynote officials, but for me, I'm staying long. I think this goes above 147. The rate of change is always the most important thing for the Bank of Japan, rather than just absolute levels. But I think above 147 into 150, we're getting into that twilight zone where you're going to see a barrage of headlines coming through. And that's going to make it tough to be long, and that's obviously the idea behind this. But right now, with carry and everything that's going on, I still like this higher.
Well, above 145, I can't disagree, and I do believe we are in the, we're in the area, the 145 to 147 level, maybe even all the way up to 150, as you pointed out. Those are levels. I know there's a lot of banks that are targeting like 152. I just make it real simple for you. While you're above 145, I don't see any reason to be on the short side, unless it's speculative in nature and you believe that you think that we're on the cusp of some intervention, or at least some verbal intervention from the Ministry of Finance or the Bank of Japan. But a lot of comments and a lot of murmuring starting to go around, and I think you do have to be cautious. I think whether you're trading it on the long side or on the short side, keep your size manageable and know where your stops are at. And if you get stopped out, like I happen to be trading this the other direction, Chris, so I happen to be on the other side of you. But I know where my stops are at, and I know my position sizing, and I know my risk. and I know it's a hedge against my other dollars. So
there you go.
I'm willing to take a stab at it on this pair. But if I'm wrong, I'm wrong. I've been wrong in this pair before.
I said on Twitter yesterday that you're like, if you were an animal, it would be an owl because you're wise, and I think that's some wise words there, Blake. I mean, I still like this long because it's going up really, and there's no real reason. But everyone in macro world is like, what's the level for intervention? Is this time slightly different from the last period? Are they less? Is there less need to do it this time around? Are they actually going to, even if they were to come out the MOF to sell currency and buy yens effectively, is it actually going to have a lasting impact, or people just going to buy that pullback? But yeah, I think position sizing when you're long, will limit yourself if we were to see a 500 pip rip to the downside. So yeah, absolutely a chart that's top of mind. So
always. All right. Well, my setup that I brought here today is going to be gold, and I think gold looks very vulnerable. Now, look, I know people are very sensitive when you talk about gold. I'm more of a long-term gold bull, but I think near-term we're at a quadruple confluence. And that's what I pointed out to our traders today, is if you take that descending trend line, it connects all the way down to where we're currently at. We are just below the 200-day moving average, which, makes it a little vulnerable at this point. Horizontal support comes in at 1890. And it seems like we're just below the 38% retracement, depending on how high your spikes go on that move higher earlier this year. At any rate, I believe below 1890 could open up a trap door. It could be quick. If you guys are looking for longs, you might be able to pick it up as we close in at the 50% retracement around the 1850 level. The flip side to that is, hey, maybe this level does hold, but I think stops are really probably gathered around there. And as long as yields continue to go up and you see the dollar continue to rally, I think the risks are building that we'd see a downside, at least a quick downside break, even if anything, to take the stops out, to take all the long stops out. Anyway, how are you seeing gold here, Chris?
I wasn't really listening. I wasn't paying attention to what you're saying, to be honest, because I was thinking about the last time I actually went to someone's house and saw a trap door. It's been a while, isn't it? Maybe something that's sort of been phased out over time. It was probably prevalent back in your area, but less houses are being built with trap doors these days.
Unless you're a mob boss. If you're a mob boss, you might have a trap door in your house with alligators.
Fundamentally, I don't like gold. I see no reason to be long gold. As I say, you can go and get 5.5% yield in 6-month Treasury bills. Real rates are moving above 2%, eyeing 2% in 10s. The US dollar's in beast mode. It's all the signs that say, like, why would you want to be long gold? And you hedge yourself against the recession, and of course, your recession risks are getting blown out. Go and have a look at SOFR rates for 2024. We've priced out a decent amount of rate cuts for next year. There's still some there, obviously, but all those factors are very gold negative. The positive for gold is that you've had the kitchen sink chucked at gold fundamentally, and it held in pretty well. I think resilience, there's some drawdown there, but it's pretty resilient given all of those factors we've been seeing. The question is what's going to cause a material bounce? Well, you have to see a trend in the data flow. If China was to really kick off and people really concerned about a credit event and that spilt over into wider credit spreads globally, we saw a wider equity drawdown and people started pricing in a high degree of recession risk, gold's going to absolutely fly. But that's not going to be a one-day affair. But look, the technicals there. So fundamentally, I don't like gold. We've been talking about it for a while. Probably some of it's in the price, a large amount of that's in the price, but the investment case for gold right here is not there. I know what will cause it, and when I see that, then I want to ramp it up. But from a trade, we might get a bit of a bounce off those levels. Fundamentally, I think it goes lower though. We'll see.
Well, that's a teaser. That means you have to be listening here each and every week to the trade-off. Can't miss any shows because we'll be cluing you in. At least.
Well, gold's a great hedge in your portfolio against the symptoms of higher rates and recession risk and all these factors. But when we see those signs, you increase your allocation towards gold in your portfolio. We know what it's used for, and we can increase it when it does that. Right now, no one's really buying it for those purposes. So if you want to hedge equity drawdown, you've been buying puts and most prominently been buying US dollars against that situation because the low correlation or the negative correlations, that's the one there. Sterling Aussie, let's go into that one, please, Mr. Producer. Sterling Aussie. Okay, cool. We have a question from King Kim Jong-un, and it's good to see, Blake, that the program is getting out to the wider masses, and some colourful characters there as well. Sterling Aussie, it's my take from last week. So this is a question that we saw from last week, which we didn't get round to, but I think we've picked it out. Because it's a really poignant point at the moment. So, what's going on there? Both countries, the narrative from the RBA, what's happening with inflation in the UK. So I'm going to break that down because we've just seen a UK inflation number that was slightly hotter than expected. Wage numbers, which you can slice and dice whichever way you want, but they were pretty hot. And then you've got the market in the UK now pricing terminal around 6%, where the cash rate could get to, or the bank rate could get to. The pound's been the flavour du jour, along with the US dollar. Because of those forces that are taking place. This has just been a crazy trade. The Aussie's been weak because of obviously its massive leverage towards China, and China's markets are still not offering us any love there. So you've got this trading. You've got you're marrying off two forces, one which everyone's loving, and one which everyone despises. And you put them together and you get a trend like this. The question, of course, is does this continue to go up to, say, the two handle? Obviously, nothing's ever linear, and pullbacks will be bought. But until, I think, for me, Blake, until such time that the Chinese government come out and give us a coherent plan that we can sink our teeth into, I think people are bold pullbacks, and I think two's a feasible level. What do you think?
I think 2 is a feasible level because that happens to be a channel resistance. If you drew parallel lines, connecting the lows and connecting the highs, it takes you right to 2. So, here's one thing, and I'm just going to throw this out there. Something that I've been watching very carefully, and anybody who knows me and knows that I'm watching the Aussie dollar as we approach the 64-cent level, which at the time of us filming, we're trading at 64.04. We are on support as the pound Aussie lurches higher. This isn't even a live chart. So we're actually another 40, 50 pips higher from when you took the screenshot of this particular pair. So that just shows you how close we are, and we're just 150 pips off of that 2 level. But I'm going to tell you this, I'll be watching the Aussie dollar at 64 cents because it's a long-term trend line that connects the post-COVID lockdown lows all the way to current price. If that breaks, pound Aussie could go higher than 2. And I think that's a risk.
I think that we're going to Aussie CAD, but the one thing, China equities, if they bounce, sentiment towards China is max bearish right now. Dollar CNH has just been going up and up and up, and outflows to China have been there. Any positive headline will cause a significant rally in the Chinese equity market. We don't know if we're going to get them, but if we got something that we can sink our teeth into, that's tangible, that's going to address what's happening in the property space and cause really bring out demand and consumption. If we get those headlines, which we've been promised, and a plan that we can work with, that the Aussie's going to have a big rally. There's no doubt in my mind. You could see the Hang Seng up 4-5% in a day. The question is when does it come? Until that such time that we get those headlines, I think sterling Aussie continues to climb higher for people who are buying pullbacks.
Well, with that being said, Chris, maybe the better option is going to be the next trade that one of our viewers, Paul, brought up, is playing the Aussie Canadian off of the channel lows. Now, this question was from a couple of weeks ago, but it's still very relevant today because he's following this descending channel. We're at or just below the 88% retracement. We could go a little bit lower, but as I was just explaining with the Aussie dollar, we're so close to 64 cents right now. Matter of fact, as I'm looking at live quotes, we're 2 pips away from 64 cents. We're near really key support there. And if it can hold, if the Aussie can really fiend off the bears from the 64 cent level, or maybe perhaps there's some favorable Chinese news, the Aussie Canadian might be a good play, especially as crude oil starts to roll over. But instead of looking at it as a channel, look at it as a descending wedge. And that's with that descending trend line. The break of that would be a move back above, let's just call it 88 cents in the Aussie Canadian. We break back above that, then we might challenge the range highs, which would take us, 150 pips higher. So what do you think about the Aussie Canadian here?
Well, I'm just looking down. I can see a cheeky bit of a divergence or triple divergence playing through as well, which on that RSI, which needs to play out. I mean, obviously for me, given my views, is if we were going to see a bounce in the Aussie, I think it'd probably come against the Canadian dollar rather than the US dollar, and it would be more sustained rather than a one-day affair. But the technicals are the technicals, and the price action, the behaviour, the aggregation of those behaviours are obviously mapped out into that. So you've got that triple divergence, positive bullish divergence playing through. If it breaks through the wedge and the downtrend, you can see, then I think that would offer us as a pretty decent setup. And what's going to cause that? I have no idea. I have a checklist of things that could cause that, and I suspect it would be down to some positive news around China and in incredibly bearish sentiment. So, I think if you're looking to play China, and we were to see that snap back at some stage, that setup will complete, and you can see that in the price action. So, I think this is one that you put on the radar. It's a good setup. I appreciate you bringing that on. And we just need that news flow to trigger us now. So we'll watch and wait. But the thing is with China's news flow is first movers advantage. When you get those headlines coming through, you need to act. And I think you probably see that in the equity flow. If you look at the H shares or the CN50 or the HK50, the Hang Seng, if we saw a really strong buying coming in, I think that's really going to be the trigger for Aussie longs to work quite well. So good one there. We'll see. So on the radar, let's go, mate.
May I mention? Thank you, Paul, once again for bringing that question, and Kim Jong Un as well. From North Korea, we appreciate that as well. But if you guys have any questions, any setups that you'd like us to comment on, please jump in the comments down below, and Chris and I are going to try to tackle a couple every week. So.
Bring it on. Thanks, guys. All right, let's go into play of the day. Okay. Last week I brought out Nat Gas. It was I took the trade off. We're still waiting for the negotiations around what's happening in Western Australia. But it's just been crazy volatile, as it has been to an extent in Brent. But certainly, taking that one off for a loss. So, not a great play of the day. But obviously, that's trading. Today, I'm looking at a long short idea, and I'm looking at being short the Russell and long the US 30 or the Dow. I do think there's probably some further downside in equity markets. But in case if we do see a bounce, I want to protect myself to an extent, and I just want to play the relativity game. And right now, given everything that we're seeing with higher bond yields and concerns around financials, which we're talking about Fitch again looking to downgrade further. There's such a heavy component of financials in mid cap and smaller banks in that Russell 2000 that I think we're going to see the blue chip index outperform the Russell, the small cap index, the Russell. And you can see that right now because you've got the Russell, which is your numerator, and you've got the US the US 30, the Dow is your denominator. And as that market's going down, as you can see there, you're seeing the Dow outperform. So it's already working well. I think this has got further juice. So I think that we're going to see continued underperformance from small caps relative to large caps. And the way I want to play that is through a long short idea. So being short the US 2000 and being long the US 30 is a pairs trade long short strategy playing through. So it's already working. I still think the fundamentals suggest there's further juice to come. I think we're going to see underperformance, and that's the way I want to play it.
I love those pairs trades that you bring here to the trade-off. So thank you for that, Chris. So my play of the day is going to be, like I said, it's going to be a volatility play, but it's the US dollar, Mexican peso, and the VIX. Now, I want to say it's fiesta time, but it isn't. And this is one of those things that Chris mentioned earlier today in the show. Hey, where's vol? Where's the spike up in volatility? You'll notice the very strong correlation between the US dollar, Mexican peso, and volatility. So we all know where the breakout point is in the dollar Mexican peso, at least those of us that are following it, is at 1744. Or you can just round it up and say 1745. That's the exchange rate that needs to be broken to the upside before you play on the long side. However, if you want a little bit of a clue if that's going to happen or not, wait for the VIX to break out. If the VIX breaks above the 18.5 handle, starts trading up towards 19, then we know volatility is increasing. We know that as volatility increases, risk aversion is increasing. The dollar Mexican peso would be prone to breaking out to the upside. So that is, and I'm trading it to the long side. I already am long. I'm slightly in the money right now. It actually costs money to carry this, But if you really want to be clued in that it is going to move, in my opinion, make sure volatility is breaking well above 18. That happens. That's your cue. And if you follow me via Twitter, you probably saw that yesterday. I posted that chart.
And if you're not following Blake on Twitter, you're missing out. You brought up a keyword there, and that's carry. And you are seeing, if volatility goes up, the first thing that gets unwound is carry positions, and there's a lot of money in that. So, the Mexican peso has been one of the carry darlings. And if we were to see volatility kick up, that is the key for funds to de-risk that carry position, and that's going to cause the Mexican peso to unwind. And it's why you probably see the yen rally because of carry being unwound. It's the preeminent funder there. So watch that. And I think you probably if you want to look at that one, have a look at MEX versus the yen, because as I say, the yen is a better funder. So that's a good one there.
It actually just hit trend highs this week, or just like yesterday, I think. It's amazing.
So
moves.
carry's being unwound a little bit at the moment, certainly in LATAM FX. But the key driver of that is always volatility. Volatility kicks up, you see an unwind of that. So it's an interesting one. Anyway, Blake, I appreciate all your comments, and anyone out there for staying this long, smash the like button and give us a comment. Let us know how you're trading the market, and also any setups that you want us to look at for next week. We'd really appreciate those. And we'll see you back next week for more of the Trade Off.